Welcome everybody, and today we will discuss about unit linked insurance policy. Today's lecture will not be like a sectional analysis and all. As a layman, we will try to understand how the ULIP taxation will be and how it will impact your life. And second important, because there are amendments which are applicable for your November-December examinations of 2022 and further exams also. So from exam perspective also you will get full clarity on this. So are you all ready? So we are discussing about taxation of ULIP. What is the full form of ULIP? Unit linked insurance plan. Now what is insurance? Suppose we are only talking about life insurance now. Suppose a person has taken life insurance, what will happen? If he dies, his nominee will get some amount. If he is alive, because the policy is for 10 years, 20 years, and the policy matured at that time also he is alive, then he will get that amount. The amount which he gets on the maturity, or if the policy holder dies, his nominee will get, is called as maturity amount. Now we understood what is insurance, but we should also understand what is ULIP, right? So unit linked insurance policy is a wonderful alternative to mutual funds, the provident fund, right? Why? Because it will give you good returns and also it will give you protection in case of death or any other problem, financial protection, right? So that's what the advantage is. So ULIP is simply an insurance plus investment plan. You should understand that ULIP is an insurance plus investment. So it will give you some good returns, more than 8%, and also insurance cover in case of death or maturity of the policy. You will get some lump sum amount on maturity or on death. Now where the money will be invested? You will give money to companies like LIC, right? Tata Capital, Tata Insurance is there. But where will they invest the money? They will invest your money in share market and debt market. Now share market, you know, debt market is loan instrument, debentures, bonds. In that they will invest. They will try to get more returns. Suppose they earn 15-16%, they will give you around 10%, and that margin is their profits. Okay. So this is the best policy if you want to get some returns on. Now come to the taxation aspect. How ULIP is taxed? First thing, please understand, if the amount is received on ULIP on the death of the assessee. Suppose example, Rakesh Junjulwala has taken ULIP policy. In that case, because he died, his family members got the money. In that case, there will be no taxation. So family members will not be asked to pay any tax on the maturity of the amount. Okay, irrespective of how much amount he is paying to the insurance company for ULIP. Okay, so on death, no tax at all. The nominee receiving money will not pay a single rupee tax, fully exempt. Clear? Okay. Now in all other cases, we have to divide between two parts. Is the policy taken before 1st February 2021 or is it taken on or after 1st February 2021? Suppose if it is taken before 1st February, it is mostly exempt. But there is one exception. But if it is on or after 1st February 2021, then we will be discussing anyhow. So anyhow, let's move to the next slide so that we'll understand. But please keep these categories into mind, that policy taken before 1st February 2021 and on or after February 21, both the treatment in these two cases will be different. Okay, right. Now come to section 10, subsection 10D. What it says, that if you have taken any ULIP, it is generally exempt. But if it is taken in the name of Keyman insurance policy, like company is taking the policy on the life of the employees, top employees of the company, on them the company has taken, then in that case the ULIP is always taxable, even before 2021 1st February and even after that. That means it was taxable, it is taxable, it will be taxable as of now. Okay, if it is Keyman insurance policy. Now who will pay tax? Suppose if the employee receives, employee will pay tax under the head salary. If the company receives the money, then company will pay tax under PGBP. And if any other person like nominees receive the money, then it is taxable under income from other sources. Right? Let's come to the next point. Now, you would have actually read under section 80C that you will get deduction for life insurance premium. Now you will get deduction how much? Deduction cannot be more than 10%, 15%, 20% we discussed under 80C, if you remember. Yes. If the insurance policy, even ULIP is insurance policy, so that provision applies to ULIP also. If the ULIP or any insurance policy is taken before 1st April 2012, then it is 20%. If it is on or after 1st April 2012, then it is 10%. But for disabled people, if it is taken on or after 1st April 2013, then it is not 10 but 15%. Right? Now when you discuss that 20, 10, 15 of what? These 10, 20, 15 are insurance premiums. What are they? Insurance premium. You pay yearly premium, right? So that you will get some money at the maturity. That insurance premium I am talking about. That insurance premium cannot be more than the specified limit. Suppose your maturity is 10 lakhs rupees and your insurance premium is suppose 80,000 rupees. So when we calculate 10 lakhs into 10%, it will come to 1 lakh rupees. Right? 10 lakh is maturity amount, into 10%, it will come to 1 lakh rupees. Now what is my premium? 80,000. So less than 10%. So maturity is not taxable. So when you receive that 10 lakhs amount, right, it is not at all taxable. But suppose you are not paying 80,000 yearly, but you are paying 1,50,000 for 3 years or 4 years, something like that. Then they will check 10 lakhs is your maturity amount into 10%, because after 1st April 2012 it is 10%, right? That's why I am taking 10% example. Then it will come to 1 lakh and your premium is more than 1 lakh, right? More than 10%. In this case, entire 10 lakhs when you receive on maturity is fully taxable. Okay? So whenever you take any insurance policy, whether it is ULIP or any others, please keep in mind that your premium should be less than 10%. If you are disabled, then it can be less than 15%. And if it is before 1st April 2012, then it can be less than 20%. You will enjoy the exemption of maturity. And if the premium in any single year, if the premium in any single year exceeds the specified percentage, then the entire maturity is taxable. Now I said Keyman insurance policy is fully taxable. I said this premium exceeding specified limit is taxable. In this case, maturity is fully taxable. Now, when you took the insurance, ULIP or normal insurance, is it before 1st February 2021 or on or after 1st February 2021? It doesn't make any difference. If it is Keyman insurance policy, if it is premium exceeding specified limit, that 10, 20, 15, then it is taxable irrespective of whether it is before 1st Feb or after 1st Feb 2021. Then what is the new amendment after 1st Feb 2021? That's we are going to discuss now. If suppose the ULIP, it is only applicable to ULIP, please understand, okay. If the ULIP is taken on or after 1st Feb 2021 and the premium is more than 2,50,000. Now in the last slide, it was just 10, 15, 20%. A percentage of the maturity amount. But in this slide, they said, did not tell percentage, they said amount. Arey yaar, if you are paying 2,50,000 or more only for your insurance, that too ULIP, in that case, you are a rich person. And why should we give exemption to rich people? No, we'll tax them. And that's why government said, no problem, the entire maturity will be taxable. Okay. So please remember, is it on or after 1st Feb 2021? And is the premium in any single year more than 2,50,000? Or sometimes you have multiple ULIPs. Then you have to do the total of all the premiums of multiple ULIPs. And if it exceeds 2,50,000, suppose I have 3 policies, 1 lakh premium, 1 lakh premium, 1 lakh premium. So in that case, first policy is exempt, 1 lakh wala. First premium, policy premium 1 lakh I paid, that is exempt. Second wala also exempt. But the third policy, entire amount of maturity, ye 1 lakh is just premium I said, right? Entire maturity amount for third policy is fully taxable. Clear? Now let's go to the next slide. So you understood this. Now to tax under which head? Salary, house property, PGEP, capital gains, other sources. So ULIP is a policy. It's an asset in simple language. When you invest in share market directly or indirectly, shares are asset, mutual funds are assets. Same way this is also considered as asset. And because ULIP is taken minimum for 5 years, they consider it as a capital asset anyhow. That's why they included it in the definition of capital asset. So if you are not going to get any exemption under section 10 subsection 10, then ULIP will be treated as capital asset. That's it. Okay. Now you can see the next slide. That okay, it is capital asset under section 2 clause 14, and such ULIP maturity is fully taxable under capital gains head. Fully taxable under capital gains head. Now how to calculate it? Simply take the sale consideration. Under section 45(1)(b) it is discussed. So don't get tensed that how the computation has come. Simply take sale consideration. Transfer expenses anyhow will be nil. So deduct it if they give in the question. Then you will get net sale consideration. From that you deduct cost of acquisition. There is no indexation here. Okay. Simply cost of acquisition. Right. And once you deduct that cost of acquisition, you will get capital gain. It is not at all a short term capital gain, it is always long term capital gain. No doubt about it. Why? Because ULIP policy in India as per IRDA cannot be for less than 5 years. So it is long term capital asset only. Okay. And last but not the least, ULIP is taxed under section 112A. Which section? 112A. And at what rate? At the rate 10%. So slab rates are not applicable to the maturity amount. Simply 10%. So suppose on maturity you got 10 lakhs income. They will calculate 10 lakhs into 10%. Your tax amount will be 1 lakh rupees. Okay. This is how the ULIP taxation is calculated. If in the question they give that premium is suppose 2,40,000 rupees, and on that GST is also there on ULIP premium GST is added. Suppose GST is added to be something around 10%. For my convenience, I am telling 10%. So 2,40,000 plus 10%, 24,000. So it will come to 2,64,000, right? Now should we consider this to be less than 2,50,000 and get the exemption on maturity, or should we consider that it is more than 2,50,000 because after GST it is 2,64,000? Should we actually tax the entire maturity amount? What should be the right alternative? The answer is exclude the GST while considering the premium. Okay. So that's why your premium is 2,40,000 less than 2,50,000. So maturity will be exempt. Like this, you have to analyze all the provisions from exam perspective, from practical life perspective. We cover everything. We'll meet in the next video. Till then, take care. Bye everybody.